Hi, I'm Bob Woolverton, your Northwest Realty Advisor. Today we're going to talk about building wealth with real estate investments. We're going to compare what your stock portfolio has been doing in the stock market compared to what it could be doing in this appreciating market in this greater Seattle area. That's our episode today on Northwest Realty Advisor. Stick around, find out more. Normally when we talk about investments, most people are talking about their stock portfolio. And one of the things we need to look at in your stock portfolio is that bottom line. How much are you earning every year? What percentage rate of return are you getting? Now, what I'm going to show you today is that we can look at the stock market over the last 4 years, see what the rate of growth has been there versus what it could have been if you had invested in real estate and what it potentially could be moving forward. We're going to use a real life example of a condominium as an investment property. Now, hopefully you already saw my video on the Bothell homeowner that's earning 34.7% return on his cash investment. The difference there is that's his primary residence. So on his cash flow, every year there were red numbers because he's paying his own debt service. With income property, you've got a tenant that's paying the debt service. So every year, in our example, you're going to have a positive cash flow. And we're going to see what sort of rate of return you can get with that investment property compared to what you've been getting in the stock market. So the first question I've got for you today is, how is your stock portfolio doing? So when you look at that bottom line in your stock portfolio, over the last 4 years, what rate of return have you actually been earning? With real estate, I'm going to show you how in this particular real life investment, even with a conservative estimate of appreciation, we're looking at a 28.8% return on your money. That's pre-tax sales proceeds. If we go up even a mildly aggressive estimate, then we jump up to 39.8% annual percentage rate return on your investment. And if we mirror what the market has done, in this particular example, condominiums in that zip code have appreciated 16.9% over the last 4 years. And if we use that, which I feel is very aggressive, you get a 43.7% return on your money. I'm not recommending being that aggressive, but we'll use some conservative numbers and I'll show you exactly how I calculate those returns. So now we look at this Totem Lake condo, and this actually came up because a friend of mine had this condo listed, and in her marketing remarks, she mentioned that this was a great rental opportunity. That rents in this area were going for as high as $1,800 a month. There was no rental cap, and for the low purchase price, this could be great income opportunity. So I thought, well, let me run the numbers on it and look at it. So that's what I'm going to do for you today. We're going to look at this particular example. So this Totem Lake condo is a 2-bed, 1-bath, 860 square feet. It's in the 98034 zip code, so it's right by Totem Lake Mall. As the listing agent said, rents go in there for about $1,800 a month, and the list price on this condo was $268,000. Now, in that zip code, when we look at the last 4 years of appreciation for condominiums, they've appreciated by 16.9% per year. Okay. However, we're not going to use that number in our particular calculations. In essence, what we're going to do is we're going to flip over to the spreadsheet, and I'm going to show you how we calculate the return on this property. So here we have the proposed sales price of $268,000. We anticipate we're going to hold this property as an investment for 4 years. Much like you might do with your stocks, you might say, I'm going to buy this stock at $50 a share. When it hits 60, I'm going to sell it. In this case, we're going to plan an exit strategy in 4 years. We're going to hold this property for 4 years and then turn around and sell it. We could do any period of time that you want, but in this example, it's just simple and easy to do 4 years. So that's what we're going to use today. We're going to calculate a rate of appreciation of only 10%. Now, like I said, in this area for the last 4 years, it's been 16.9% per year, but let's be conservative. Let's just say they're only going to appreciate at 10%. That would make the future sales price of this house in 4 years $392,379. We anticipate we're going to have a sales cost of 8%, basically 6% for real estate commissions, 1.78 Washington State excise tax. Now, with being an income property, our loan to value is going to be 75%. So we're going to need a 25% down payment. So our loan is going to be $201,000. Our down payment is going to be $67,000. We anticipate we're going to get a loan at 4%. And that's going to be a 30-year loan with 12 annual payments. Now, based off of that, we go over to the next tab and we calculate the loan amortization on this, how much we're paying in interest, how much we're paying in principal. But what we're really interested at this point in time is at the end of the 48 months, what's going to be our payoff balance, because that's how we're going to get to our pre-tax sales proceeds. Now, the next thing we look at is what are our income and expenses going to be, our annual property operating data. So now you remember the listing agent said rents are going in there for $1,800 a month. So again, I said, let's be conservative. Let's calculate $1,700 a month. That would give us $20,400 in annual income, but also let's calculate a vacancy rate. So I anticipated, say, every 24 months, you're going to have a tenant that's going to give you notice. It's going to take you a month to turn that over. So I basically calculated every 24 months, we'll have 1 month of vacancy. So there's $850 of lost income there due to the vacancy rate. So that modifies our annual income. Then we've got our real estate taxes, we've got our property insurance, we've got our HOA fees. We go on down the line. So we've got our total operating expenses of $68.48 against our net operating income. Then we've got our annual debt service. Again, that's our mortgage payment, $11,515 per year. Gives us a pre-tax cash flow on that first year of $1,187. So this is our annual property operating data. This is for the first year. Now, what we're going to do is we're going to be looking at a 4-year hold on this. So we're going to calculate our expenses over the 4-year period. Now, you'll see here in year 3, I anticipated a 5% rent increase. So we go from $1,700 to merely $85 a month. Again, I feel that's pretty conservative. Rents may go up more than that during that period of time, but it's a conservative estimate. We anticipate that increase. We don't anticipate doing any capital improvements to this project in 4 years. So we look at our potential gross income. You see in year 3, it jumps to $21,420. We still have our vacancy rate broken out over the annual periods there. Our expenses stay the same. Net operating income changes because of the income. We still have our annual debt service. So there's our positive, our pre-tax cash flow for each one of those 4 years. Now, we look at our pre-tax sales proceeds. So we know we had our proposed sales price because we did 10% increase on the purchase price over a 4-year period. The cost of the sale was the 8%, pay off the mortgage balance. There's our pre-tax sales proceeds, $175,036. Now we come over to our sub-calculations. And what we're interested in here, again, as you saw in the Bothell homeowner that made 34.7% return on his investment, in our contracts, we count days as the day that you get signed around on contract is day 0, and then day 1, day 2, day 3. Same thing here. So the very first day when you make the down payment, and this is when you buy the property, that's cash flow year 0. So you see the $67,000 down payment, that's a negative number. And then cash flow for year 1, cash flow for year 2, 3, and 4. Now, we already calculated the cash flow for years 1, 2, and 3. Cash flow for year 4 is the balance of the sales proceeds plus the income we had for that particular year. So we had a total of $177,243. That gives us an internal rate of return of 28.84% on our investment. In essence, what we did is we took a $67,000 investment, 4 years later turned it into $177,000 pre-tax sales proceeds. Now, that was a pretty conservative estimate because we calculated only 10%. So let's jump back to the General Information tab, and let's say we change that 10% and let's make it 15%. So everything else stays the same, but if we jump over to those subcalcs, we'll see that obviously our sales price, excuse me, let me go back to General tab. So our sales price jumped up to $468,000, $734, because we anticipate the property is going to increase by 15%. Still far below the 16.9 that it's been doing, but it's a bit more aggressive, but just to show you the differences here in the numbers. So now if we go over to the subcalcs, now your internal rate of return on your original $67,000 is now 39.83%. How does that compare to your stock portfolio? Substantially better. Now, if we wanted to be super, super aggressive, which I don't recommend this, the annual rate of return in this area over the last 4 years has been 16.9%. So let's plug in the 16.9% just to see the difference. So that would make our proposed future sales price $500,487. All of our expenses and our debt payment is the same. So we come over to our subcalcs, we see our original $67,000 down payment. Now our pre-tax sales proceeds at $276,703 for an internal rate of return for 43.7%. How does that compare to your investment portfolio on the stock market? Substantially better. Now, let's be a little more reasonable. Let's go back and plug in the 10%. Come back here to subcalcs. Now, if this is your expectation at 28.8%, which I'm sure is far better than what you're doing in the stock market, that's an excellent rate of return. If the property happens to appreciate more than that, will exceed your expectations. But these are pretty conservative numbers. We used a lower rental number. We used a lower appreciation rate. So we're being very conservative about the potential growth and return on your investment in this particular property. That's exactly how people create wealth in real estate, by leveraging debt, because what you're doing is you're borrowing 75% of the value at 4%, and yet the property's appreciating at what we're estimating to be 10%. So you're making money on that debt, the power of using other people's money. So here in that example, in 4 years, we turned your $67,000 investment with that conservative estimate into $177,000 or a 28.8% return. If we went mildly aggressive or we achieved that number, potentially 39.8%, turn that $67,000 into $247,000 after 4 years. And we did the market rate just to show what it's really done in the last 4 years. We can't guarantee it's going to continue to do that, just like your stockbroker doesn't make any guarantees about the future performance of stocks. These are all estimates, shows what the market has done historically, potentially what you could do moving forward in your real estate investments. But we get back to that question is, how's your stock portfolio doing? We know building wealth in America is done through investing in real estate. That's an example of how you can calculate the return on your investment and go in knowingly to an investment so that you're making a very wise investment. If you'd like to know more, give me a call. I'm Bob Woolverton, your Northwest Realty Advisor. My phone number's down in the comments below. Give me a call, send me an email, I'll answer any question. We can analyze any property that you like for its investment potential. We have new videos here every week. Please click that subscribe button. That gives me feedback that you are finding value in what I'm offering in this YouTube channel. And click that share button, copy the link that pops up, and send it to a friend so they can see the video too. I'm Bob Woolverton, your Northwest Realty Advisor. We got new videos every week. Come on back next week.